everyone. Welcome to a brand new episode of Market Manthan powered by ZBiz.com. Well, my name is Shatajanand, and today we have a very special guest with us, Viraj Mehta, who's a managing director, PMS at Equirus. Well, Viraj has over 11 years of experience in the field of investing with an excellent and proven track record. Well, he manages the Equirus Long Horizon Fund, and it is one of the best performing funds since its launch in October 2016. Well, welcome to the show, Viraj.
Thank you. Thank you so much, Kshitij. It's always been a pleasure interacting with you. And, I look forward to our interaction today as well.
All right. Well, thank you for your kind words, Viraj. Well, to start with, let's talk about markets. We are in the last month of the year 2021. It has been volatile, especially in the second half of 2021. The first half was pretty, you could say it went on a steady pace, but then we saw some bit of volatility in the second half of 2021, and with new things coming up, such as monetary tightening from the US, Omicron fears as well. They are also getting built up in the market price. So what are your views on the market for the year 2022?
So it's a great question. Actually, if this question would have been asked to me probably 5-7 years back, I was far more cockier and I had far more faith in my ability to tell you that this, I think, will happen next year. I think market over a period of time has kind of humbled all of us. And if you were to look at the best economists in the country, sure, and think about how they think about 1 year targets of such an index, I think 85% of those things are just not right. I mean, I think it's a dart game, and if you were to put a gun to my head and think what is the one thing which could happen, I think after such a steep rise, it is very possible that market probably takes a breather, consolidates 5-10% plus minus. The action, I think, will be far more stock specific, and not to say it has not been. Like, India has been a stock specific market for 20 years now.
True.
Which is why I think as a smaller retail investor, I think you just want to be detached with this headline and index numbers and not worry about it too much. It's a little convoluted answer to a straight question.
No. In fact, I agree on that point, because we've seen 2 straight years of a steep rise in the market, and 2021, if not 60%, at least, we'll close the year with some double-digit gains. And by all means, or by all yardsticks, it is quite handsome gains for equity investors when we compare with other asset classes. If crypto you're including as an asset class, then probably, yeah, we might not be. But then, with the traditional asset classes, we've been able to outperform quite a bit. One of the reasons of, sell-off in the market was relentless, you could say, selling of foreign institutional investors. Quite really, they might have started factoring in some bit of tightening from the US Fed in the year 2022. So, how do you see FII movement or FII, interest towards Indian markets in the next year?
So, if you look at data of last even 2 years, where FIIs have been seller in India, they have been sellers in secondary market, but they have been a significant buyer in primary market.
Sure.
If you look at all the new age IPOs, which have garnered a lot of capital, which Absolutely. Have garnered basically the majority of the capital, especially in last 3 months, 4 months. You look at right from something like PDM to a Nykaa, to some of the smaller ones as well. These guys have been largely the institutional investors, and mostly very few domestic mutual funds or insurance companies have participated in these. So sure. Whatever has been sold, a large chunk of it has actually come back through primary market. So we technically can't say they've sold a lot of Indian equities. Going forward, I think India also relatively outperformed, and that was second point, is that India has relatively outperformed a lot of other emerging markets.
True.
And which is why the difference between Indian valuation and emerging market valuation, and you can look at different countries, even excluding China, has significantly gone up, especially in last, I would say, 6 to 9 months.
Okay.
In that environment, a little bit of money being taken out and deployed somewhere else, I think is not a new thing. I do not really think that Fed taper is such a big factor when it comes to Indian money. A large part of Indian money still comes through passive money, and it will not be largely impacted due to taper is what our belief is.
Right. Well, I think I would like to add one more thing here is that apart from FIIs who put in money in the primary market, retail investors also really, contributed to the oversubscription that we have seen in most of the IPOs that have got by, even though they might not be oversubscribed in totality, but the retail portion, was oversubscribed in probably in few hours that we have seen the trend. So yeah, so we'll definitely come to that point later in the discussion. But for now, as we move, to the new year, the big thing to talk about is definitely, the budget 2022. We've seen already various government schemes kicking in ahead of the budget, which really, means that government means business at this point in time. So what are your views on the budget, expectations from the budget, as well as any sectors which you think could grab the spotlight in the new one?
So if you look at right from NDA as in Modi first government,
sure.
Right from 2014, they've made it and tried to make it more and more decentralized apart from the budget. So now what has happened is that you have government coming in with all the new announcement, all the new schemes throughout the year, not particularly centered around the budget. I do not actually think that budget has been very relevant in last 5-7 years, except probably when that one tax change happened in 2018 budget by Mr. Jaitley. Except that budget has been, in our mind, it's mostly been a non-event. Even the big thing like GST was passed apart from the budget. Even the corporate tax cut, which is the biggest, I would say, benefit which has been given to Indian corporate sector, was done sometime in August. I mean, it was just in the middle of the year. So I think a lot of these things, government does have a lot of feedback mechanism. They do listen to the industry. And whenever required, they don't essentially wait for the budget to come and then do something about it. So yes. I think budget will be a rudimentary event. I mean, it'll just come and go without much jazz. The idea is that we have a government which I truly think believes in more corporate sector, believes in more startup India, is probably doing everything in its machinery within the circumstances that it has to encourage what India is supposed to deliver. So kudos for that. So I definitely think that India is doing a lot for it, right from reducing the tax rates to incentivizing PLI schemes to reducing the number of registrations required or the compliance requirements that are there. All of these will go a long way, but they're probably not part of the budget or not part of the big bang first page newspaper. But I guess they are equally, if not more important.
All right. Well, boost for manufacturers, or we could say make it India. That is the theme which government promotes at this point in time. I'm sure that will be the theme for the next year as well. Now, if you want to pick any sectors, if you look at the year 2021, power, metals, and realty are some of the sectors which really, saw quite a bit of buying pressure. They could be underperformers in the past as well, and some value buying could have kicked in. What is the kind of view that you have for the next year for these sectors?
So, great question. Yeah. So we generally think sectors which are going to see a lot of RM inflation should significantly underperform already, given a very high valuation that they trade at. From staples to some of discretionary should kind of mean revert, and they could be significant underperformers over next 2 to 3 years. I think there are segments which have not done anything for 10 years, and there are survivors in those segments, and their balance sheets are clean, and now they are seeing significant tailwinds of growth. For example, think about the number of power plants or 500 plus megawatt power plants which have been put up in India. You'll be surprised how less that number is. Or you think about the number of capital goods players which are remaining who can do this job, right? So we think somebody in real estate, power, building materials, and capital goods should see a significant uptick in terms of revenue and margins as well because of the operating leverage. And then the valuation at which they're trading makes them, in our view, a very, very attractive position to be in.
Right. So any stocks or sectors that be on your list for the next year?
So as I said, I think things which have not done well, like capital goods. In capital goods, you can play it across segments. So either you can think about playing them through wires and cables, like the stocks we own, or you can play it through traditional cap good players with good balance sheets, like ISJEC, Siemens, Thermax kind of players. Or you can think about playing them through some of the smaller, shorter cycle players, like a bearing players. So there are various ways to skin the cat. But I would think this is the sector where the pot of gold lies.
Right. Duly noted, and quite a bit of suggestions for our viewers as well on that. Another thing I want to put it across, that equity markets are likely to, we've discussed earlier in the show as well, the equity markets are likely to close the year 2021 with on a double-digit note. So how are different asset classes performed and outlook you have for 2022? And will equity remain the preferred asset class for the year 2022? Why I say that is because, we've seen 2 straight years of quite a bit of gains, and should investors rejig their asset allocation strategy, and as you already pointed out, that there could be 2022 could be a year of some bit of consolidation. There could be some bit of correction coming in. So how do you see that, or what would you advise to retail investors on that front?
So essentially, I think any investor who starts investing in equity or debt market or any other asset class as such should have an asset allocation goal to begin with.
Yes.
And if there is significant divergence between the asset classes or performance of asset classes because of returns, it is reasonably advisable to think about reallocation at the end of the year. It doesn't have to follow a quarterly strategy. We think end of the year kind of reallocation, especially for people with lower risk appetite, probably 55 or higher in age, and have lower risk appetite, to probably rejig if equity has become larger portion of their portfolio, to kind of rejig the portfolio a little. But we would advise against doing any large changes. To materially to both the asset allocation strategy that you have put out, and large divergences that you think you want to make. Like, let's say if your ideal is probably 55% equity and it has become 60-62, it's fairly understandable that you want to take it back to 55. But to think that equity will not do anything and will bring it down to 35, and then when equity will go up, will bring it up to 55, I think that kind of large reallocation should absolutely be avoided.
Right. Well, golden words coming from Viraj. Now, it is important for retail investors to understand that not to rejig their portfolio frequently, and not to look at their portfolios as well, on a consistent basis, especially if you are a long-term investors. Any advice you would like to, give to investors on that front, sir?
No, I didn't get that question. You are saying not looking at the portfolio, right?
Yes, absolutely.
Warren Buffett says is the best, right? He says the best investors are those who are dead and those who didn't know their portfolios existed, right? The returns of some of these guys tend to be the highest. One interesting fact is, and which I would like to, probably point out to your investors, is what tends to happen, and with probably an Indian mentality, also probably globally as well, is that we always want the best, or we want to be the top quartile. Like if you are an Indian mother You want your son to be or your daughter to be ranked number 1. I mean, rank 10 is great out of 50, but they want them to be number 1.
Number 1, yes.
You can't change your child if it is number 10, but if you can change your asset manager if he's ranked 10.
Right.
So what tends to happen is people move across with the flavor of the market, and strategies tend to be a little mean reverting. So they kind of end up in the portfolios which have done the best in last 2 or 3 years, and then end up underperforming over next 2 to 3 years. I would seriously advise against this kind of rejigging. If your asset manager is doing a decent job over a 2 to 3 year period, does not need to be top decile every year, even if he's in, I mean, one statistic, if in US, if you are in top half every year of last decade, you end up in top decile for the 10-year period.
Okay.
So, I mean, you can just be in top half and be okay. So I guess that understanding and that nuanced understanding needs to get to investors for a slightly better, I would say, outcome over a longer period of time.
Absolutely. Well, I think this advice is more crucial, especially at a time when, a lot of retail investors have jumped on the street, especially during the pandemic. So yes, do take care of these valuable advices. Apart from that, there's another trend which has picked up, especially post the pandemic, and that is international investing and ETF investing. So what is the trend that you foresee for 2022?
So, I mean, you think about US and international investing actually in India is not very diversified. When in India, we talk about international investing, we generally end up being in US, and within US, I think majority of the money flows into NASDAQ. Because that's been, we just talked about that the best asset classes tend to get the best money at the top. I think we are investing in good companies in NASDAQ, but at an absolute bonker valuation. Some of these NASDAQ companies are trading at ridiculously high valuation, and US profit to GDP is at 2-decade high. Whereas in India, we are at a 2-decade low. So I think international investing is great, but please know your market. Also, international investing does not always mean US. Also look at, there are some good funds who are offering China, who are offering Vietnam, who are offering Cambodia, Asia funds, who are offering some of the Middle Eastern funds, who are offering some of the European funds. I think that is truly international investing, gives you flavor across markets, also diversifies your risk against one country, which is fairly richly valued in my view. So that would be my take on international investing.
Right. I think country risk is something which investors should take note of while putting their money in international funds. Now, I think the probably my last question to you would be, although we've discussed throughout the discussion, in the interview, but what would be your, advice to retail investors, especially traders who have really, come to the street thinking that, this is one of the ways of making money. Well, the tables could turn any time around. So any advice that you would like to, give it to them as well?
So traders, I actually have no advice. I've never done trading in my life. So again, what I've not done, I can't really advise. Investors, I think the best advice I can only give is please moderate your expectation. What has happened over last couple of years is absolutely not repeatable over a longer period of time. If somebody tells you that 25% CAGR is a norm, is absolutely lying through their teeth. Do not believe such people. I think the best way to think about your equity investments is country grows as X. Let's say for India grows at 7%. There is an inflation of 4%, so 11, and your company probably grows 2 or 3% higher. So probably 13, 14% is a fair and a reasonable expectation to have over a longish period of time. Having very, very high bars for having very high bar of expectation from your investment returns would lead to subpar happiness, or you'll be sad looking at your returns 10 years out there. So I think, like all things in life, just keep your expectations a little somber.
Right. Pay your expectation, or slightly pay down your expectations a bit for the next year. That's the word coming from Viraj. Well, interesting discussion, sir. And again, thank you so much for your time. And well, that's for now, but do stay log on to zeebiz.com for more on news, business, and economy. Well, thank you so much for your time, Viraj.